Hi, it's John Crane, and I wanted to talk about a trade in the maize sugar that I had recommended in the Traders Market Views Swing Trader Report this week. I was recommended to sell it back on the 17th of February. The entry price should have been about 26.06, and the target price was 23.65, which would have been closed out on the 24th. But I was asked the question of why I put in a projected target price to exit one day before the reversal date, and it was a little above where the reaction line came in. So I wanted to walk through the process to show you, first of all, how we came out with the projected reversal date, the targets, and why decided to exit a little bit higher and a little bit earlier. So first I want to point out that we have the TR pattern. This is what alerted us to the signal in the first place. We have the ABCD pattern here, which forms the TR pattern. And after we made the C pivot, we looked for this rally up to D, and it touched the 20 bar moving average. It did not quite reach into the 60% area, which is right here, which of course you know that is what I call my sell window. But since it touched the 20-day moving average and moved away from it, then I look at that as almost the same thing as going into the 60% window. But that's for another session, another video. So what I did at this time, I identified this as a signal bar. So of course we recommended selling it when the market broke below that bar. And you can see it was 2 days later. It was on the 17th that the market broke through here and triggered the sell signal. Of course, immediately the market came on down and you had a 2-day retracement, which of course formed a new reaction swing, which I'll get to a little bit later. That did come into play when it started making these price projections. Okay, I'm going to take you back now and show you how I come up with the reversal dates and the price projections. The first thing I typically do is once I have the D pivot point and the C pivot determined, so I know that is my reaction swing, of course I want to do my reverse count to look back in time to measure the reaction segment. And I just did this by counting the bars. I started here as 1, 2, 3, 4, 5, 6, 7, 8, 9, going back to the beginning of the TR pattern. And once I have 9, I just make my forward projections. And that'd be 1, 2, 3, 4, 5, 6, 7, 8, 9. So of course right there is my projected reversal date. Typically what I'll do is I'll come out and I'll mark that. I'll mark that ahead of time. You have to remember that this part right here does not exist when I'm making these projections. The next thing, of course, what I do is I will put on my Andrews pitchfork. This allows me to make my price projections. And I anchor it at B because that's the high of the move. And then, of course, from C to D. Next step is the reaction line. I'll just make my line from here, from C to D. Then I'll grab that and go down to where the reversal date, the projected reversal date, crosses the center line, the median line here. And that gives me my projected target. That is the reaction line. Now, of course, if I stated before, we recommended getting out on this date. And you'll see that that's 1 day before the projected reversal date. And it's also before the market hit the reaction line. The main reason I started looking at an exit price, see how the market is moving away from the center line, away from the median line. The median line I call is kind of a momentum indicator. And right now the market's trading on the right side and it's moving away. That says the market is actually gaining strength. It's stronger than it should be. If it falls below the line and goes that way, that is the weak side. That tells me it's a weaker market. If that happened, I would look for the market to come down into this area. But since it's moving away, that's a red flag. It said this market is gaining strength, and maybe it's time to start looking at exiting because you're not going to get much more downside potential. So I started looking at different price projections. Another thing I do, I'd like to use fib extensions, and so that's what I started looking at, the fib extensions, and see what they would tell me. So let's put, first thing I did is I put my Fibonacci extensions from C to B. And you can see the market's right down here. This is the 1272, is right around 2374. And remember this reaction swing right here that I mentioned? I also did a fib projection from here to see if there's a little cluster. And what you find is the 1272 and 1618 right here is a cluster. So when I determined the target price at 2365, I just looked in the center of that cluster and I said that's a pretty good area. The Fibonacci extensions, there should be some natural support there in that area. The market is, as I said, the market's moving away from the center line, so it's gaining strength. It's a good time to exit. And that's what it did. It hit that price on the 24th and exited 2365. So it was a pretty good move, and it only lasted, what was it, like 4 or 5 days? 5 days, and we were out. See what's happened to the market since then. This is what's important. It continued sideways. And 3 days later, we're still trading in the same range as our target price, and it's just now coming up against the reaction line. So my thoughts are, and based on past market behavior when I've seen this happen, this may be it for the downside. We may go sideways, we may turn back up, or it could consolidate and go a little bit further. But the big move is over. Therefore, we elected to exit this trade. So I hope this answered some of your questions and gave you a little bit of idea how I do use the action-reaction theory to make price projections. If you want to learn more, or if you want to get a free subscription, 30-day subscription to the newsletter, Traders Market Views, check out our website at tradersnetwork.com or give us a call at 800-521-0705. And I thank you for joining me here today.